The way that, PGIM is underwriting these deals, we generally underwrite to a zero credit loss. And what that means is that, we're going to take these cash flows and we're going to stress them, and we're going to build structural protections against, different economic outcomes and market stresses. So generally, we're trying to build a cash flow and pay for those cash flows in a way where we think, you're not going to bear credit loss. That said, there is always the risk that our scenarios aren't severe enough. In many of these cases, we are getting additional protection from either the end originator or the end borrower, to give us extra protection. But generally, I would say, the key thing here is really understanding the assets, making sure that, the documents and the covenants are written in the appropriate way. I think, what we're starting to see as other managers are looking to grow in the space, we fear that if they're taking, they're open to financing riskier collateral. They're either, providing less debt covenants, or giving more embedded options to the borrowers. So from our perspective, we remain fairly disciplined around lending to the right segments of the market, right? So you can mitigate risk by just staying in lending against higher quality cash flows. You can mitigate risk by ensuring that your bond covenants remain very robust in terms of what you're willing to accept and not accept. And then economically, maybe this is not a credit risk point, but more from a cash flow point, making sure that we have appropriate call protection on some of these financings to ensure that if things do improve or continue to get better, the durability of the yield premium that we negotiate on day one and hope to capture, we can capture for the life of the investment.